Welcome to Global Experts Network Learning Platform. I'm Samson Nsengiyumva, and today we're moving into Module 3 of our Investment Analysis and Decision-Making course. We'll be exploring the time value of money and return analysis, which are fundamental concepts for any serious investor or financial professional. This module builds the mathematical foundation for valuation. We will learn how to calculate present and future values, measure investment returns, and properly account for the impact of inflation on our wealth. By the end of this session, you'll be able to apply compounding and discounting concepts, value annuities and perpetuities, and distinguish between nominal and real returns. These are essential skills for practical financial modeling. The core principle is simple: a dollar today is worth more than a dollar tomorrow. This is because of earning potential, inflation, risk, and the opportunity cost of having your money tied up. Understanding why money has a time value is crucial. It's not just about interest rates. It's about the underlying risk and the missed opportunities when capital isn't working for you. Let's start with present value. Present value is the current value of a future cash flow, discounted at an appropriate rate. The formula is PV equals future value divided by 1 plus the discount rate, raised to the power of the number of periods. For example, if you're due to receive $10,000 in 5 years and the discount rate is 8%, the value of that money today is $6,806. This helps us compare current costs with future benefits. Future value is the value of a current amount at a specified date in the future, based on an assumed rate of growth. Here, the formula is FV equals present value times 1 plus the interest rate, raised to the power of n. If you invest $5,000 today at 6% annual interest, it will grow to $8,954 in 10 years. This calculation shows the power of allowing your capital to grow over time. These basic calculations are the building blocks. But in the real world, interest is often calculated more than once a year. This leads us to the concept of compounding frequency, Albert Einstein's eighth wonder of the world. Compounding means earning returns on both your initial investment and the interest you've already accumulated. Whether it's annual, quarterly, or even daily, the frequency of compounding significantly impacts your final return. Discounting is the reverse process. It tells us what future cash is worth today. A higher risk profile generally requires a higher discount rate, which in turn results in a lower present value for those future cash flows. An annuity is a series of equal payments made at regular intervals, like mortgages or car loans. We have specific formulas to calculate both the present and future values of these streams of payments. Suppose you save $1,000 per year for 20 years at 7% interest. By the end, you'll have $40,995. It's a great way to see how consistent saving pays off. Annuities are everywhere in finance. But what happens if the payments never stop? That's called a perpetuity. It might sound theoretical, but it's used to value everything from preferred stocks to entire companies. A perpetuity is an annuity that continues forever. The value is simply the payment amount divided by the required return. For a $5 annual dividend at a 10% return, the value is $50. Now let's talk about measuring performance. The holding period return is the total return earned while you held the investment. It includes both capital gains and any income, like dividends, received during that time. When looking at multiple periods, we use two types of means. The arithmetic mean is best for forecasting, while the geometric mean is the standard for measuring actual historical compound performance over time. In this scenario, with varying annual returns, the arithmetic mean suggests an 8.33% return, but the geometric mean, the real compound growth, is actually 7.49%. Accuracy is key. Notice how the geometric mean is always lower when there's volatility. This is why professional fund managers focus on compound growth. Now, let's look at how to annualize those returns for better comparison. To compare investments held for different lengths of time, we convert them to an equivalent annual rate. This standardizes the performance so we can make an apples-to-apples comparison across our entire portfolio. High returns are less impressive if they come with massive risk. The Sharpe ratio helps us evaluate returns in the context of the risk taken, measuring the excess return per unit of volatility. We also must account for inflation, which erodes purchasing power over time. A 10% nominal return sounds good, But if inflation is 3%, your real gain in purchasing power is only 7%. Nominal returns are what's reported on the face of your statement, but real returns show your true wealth change. Real returns matter more because they reflect what you can actually buy with your money. Inflation is the silent thief of wealth. As investors, we must always think in real terms. To help with this, we use the Fisher equation to relate nominal rates, real rates, and inflation accurately. The Fisher equation provides the exact relationship. For smaller rates, you can use the approximation that the nominal rate is roughly equal to the real rate plus the inflation rate. It's a quick way to check your real progress. The rule of 72 is a handy mental shortcut. Divide 72 by your annual return to estimate how many years it will take for your investment to double. At a 6% return, it takes about 12 years. Internal rate of return, or IRR, is the discount rate that makes the net present value of all cash flows equal to 0. It's a primary tool used to compare and rank different investment opportunities. Net present value is the sum of the present values of all cash inflows and outflows. Our decision rule is clear. If NPV is greater than 0, the investment adds value and should be accepted. NPV and IRR are the gold standards of decision-making. But how do we actually calculate these in the office? Most of the time, we rely on Excel. Let's look at the functions you'll use every day. Microsoft Excel has built-in functions like PV, FV, PMT, and NPV that handle the heavy lifting. Mastering these will make your financial modeling much faster and more accurate. Let's put your skills to the test. Evaluate this rental property investment by calculating the annual net cash flow and the NPV. Based on a 10% required return, would you invest? Take your time with the math. Avoid common pitfalls like mixing nominal and real rates, using the wrong compounding frequency, or forgetting to account for the impact of taxes. These errors can lead to very poor investment decisions. To summarize, money has a time value, compounding frequency matters, and real returns are what truly count. NPV and IRR remain your essential tools for disciplined investment decision-making. We've covered a lot of ground today. These mathematical foundations will serve you throughout your entire career. Take a moment to review these questions to ensure you fully grasp the concepts. Test yourself on these questions. Can you calculate the present value of $5,000? Do you understand why geometric mean is more appropriate for multi-year returns? These are key takeaways. Module 3 is now complete. You've laid the groundwork for advanced valuation and return analysis. Well done on getting through these technical calculations. Thank you for following. I hope you found this module helpful. Please subscribe to our SNB Experts YouTube channel for more financial training. Goodbye and see you next time for Module 4. Thank you for following. I hope you found this module helpful. Please subscribe to our SNB Experts YouTube channel for more financial training. Goodbye and see you next time for Module 4.